The quarterly review began without dissent. Margins had improved for 6 consecutive periods. Operating expenses were down. Revenue variance narrowed. The board approved the compensation update unanimously. A single slide showed the change. Performance bonuses would now be tied directly to short-term earnings acceleration. Cash flow velocity would determine promotion eligibility. Project approval would depend on quarterly contribution metrics. The adjustment looked precise, measurable, rational. No one questioned the shift. The company had faced stagnant growth the previous year. Analysts had noted inefficiencies. Activist investors had circulated memos emphasizing accountability. The CEO responded with alignment. Incentives were clarified. Metrics were simplified. Authority centralized around measurable outputs. Efficiency rose almost immediately. Managers cut underperforming initiatives. Teams accelerated delivery timelines. Deferred projects were eliminated. Procurement renegotiated contracts. Capital expenditure slowed. The stock price responded within weeks. Analysts praised discipline. Internal dashboards turned green. Performance calls became concise. The decision succeeded in its moment. The logic was defensible. When incentives align with measurable outcomes, performance concentrates. When compensation links to velocity, execution sharpens. When ambiguity narrows, output stabilizes. The board had not changed the mission. It had clarified rewards. But incentives are rarely neutral instruments. They amplify what they measure. They reduce what they ignore. The compensation update did not command new behavior. It redirected attention. And attention is the most powerful allocator inside any institution. No one objected because no one saw contradiction. The incentives appeared clean. The structure felt efficient. Authority looked disciplined. Authority centralized. Flexibility narrowed. The CEO's rationale was straightforward. Investors demanded predictability. Markets rewarded acceleration. Operational drift had to be constrained. By tying compensation directly to quarterly earnings growth, the company removed ambiguity from performance. Managers now knew precisely what counted. Projects without measurable short-term impacts slowed. Exploratory research budgets compressed. Long-horizon initiatives moved down priority lists. Risk tolerance recalibrated. The change did not ban innovation. It deprioritized latency. Latency became invisible. The shift also altered internal conversation. Meetings became metric-centric. Presentations foregrounded immediate contribution. Cross-departmental coordination reduced when it did not translate into short-term numbers. Efficiency improved. Internal dashboards reflected discipline. Variance declined. Forecasting accuracy increased. Externally, the firm appeared stabilized. Credit rating agencies noted stronger liquidity control. Analysts revised earnings expectations upward. Institutional shareholders increased positions. The compensation alignment achieved its purpose. The CEO's authority strengthened. Success confirmed the decision. The market interpreted discipline as competence. The board interpreted acceleration as control. Managers interpreted clarity as fairness. There was no coercion, no dramatic restructuring, no visible disruption, only refinement. But incentives function as filters. What they measure expands. What they omit contracts. Quarterly acceleration became the dominant lens. Research teams recalculated proposal framing to show near-term contribution. Product development cycles shortened. Maintenance budgets tightened. Small deferrals accumulated. Maintenance windows compressed. Vendor diversification slowed. Compliance reviews moved closer to reporting deadlines. None of these shifts violated policy. They adjusted emphasis. An interpretive fork emerged quietly. Was the organization becoming disciplined or dependent? The vote had been unanimous. The dependency wasn't. The first signal appeared 18 months later. Customer retention declined modestly. The variance was small, with an acceptable tolerance, attributable to market competition. But service complaints had increased. Internal teams responded with cost optimization. Support staffing levels adjusted downward. Automation tools deployed. Response times met threshold standards. Metrics remained within target, yet optionality narrowed. Supplier diversity had decreased during cost compression. Redundancy buffers had thinned. Talent development pipelines shortened. Recruitment favored immediate contributors over developmental potential. No single change created fragility. Accumulation did. Incentives rarely produce sudden shifts. They produce patterned emphasis. Patterned emphasis reshapes culture. Culture reshapes decision boundaries. Decision boundaries reshape risk. The CEO did not instruct managers to ignore long-term resilience. The compensation design made it secondary. Secondary priorities erode quietly. Innovation proposals increasingly included immediate revenue hooks. Experimental initiatives reframed as incremental improvements. Long-cycle research teams reduced headcount. Internal language shifted. Optional became non-essential. Deferred became optimized. Long-term became strategic placeholder. Short-term earnings continued to climb, but capital rigidity increased. When a supply chain disruption occurred 2 years later, the organization lacked alternative vendor relationships. When regulatory adjustments required documentation expansion, compliance teams were understaffed. When a competitor introduced a new technology, the firm's R&D capacity had narrowed. The institution responded efficiently, but slower than before. Flexibility had thinned. The original decision had not been flawed. It had been incomplete. Incentives do not merely reward outcomes. They structure attention. Structured attention redistributes risk, and risk, when redistributed, does not disappear. It relocates. The company did not collapse. It stabilized. Revenue remained strong. Margins held. Market perception stayed favorable, but resilience compressed. Supplier concentration increased bargaining exposure. Reduced developmental hiring narrowed succession depth. Shortened planning horizons limited scenario modeling. The institution became optimized for acceleration, not adaptation. In stable conditions, acceleration dominates. In volatile conditions, adaptation determines survival. The compensation alignment favored the first. It quietly weakened the second. This is the paradox of incentive distortion. The more precisely behavior aligns with measurement, the narrower behavior becomes. Narrow behavior increases efficiency. It reduces variance. It centralizes control, but it also reduces optionality. Optionality is expensive. It appears inefficient. It resists quantification. When optionality lacks measurable reward, it erodes. The CEO's compensation design reshaped internal gravity. Managers avoided initiatives with uncertain timelines. Middle leadership prioritized projects that matured within quarter boundaries. Strategic planning became quarterly extension rather than long horizon design. No one violated governance. No one ignored policy. Behavior adapted to reward structure. Trust did not decay. Legitimacy did not collapse. Authority did not fracture. Instead, flexibility thinned. Concentration risk increased subtly. Information asymmetry widened between short-term reporting and long-term capacity. The decision had succeeded locally. It narrowed structurally. A second interpretive fork emerged. Did discipline produce strength or dependency? Both statements could be true. Efficiency and fragility often coexist. Other firms observed the company's performance. They replicated the compensation model. Quarterly alignment structures proliferated across the sector. Short-term earnings improved broadly, but replication masked context. The original company had entered the incentive shift with diversified vendor networks. It possessed historical brand capital. It held residual resilience from earlier governance models. Its structural buffers preceded the narrowing. When competitors adopted the model without those buffers, rigidity surfaced faster. One firm faced regulatory exposure within a year due to compressed compliance staffing. Another experienced product stagnation after reducing exploratory investment. A third saw talent attrition when developmental paths disappeared. The incentive model was not universally flawed. It was context-dependent. Its success depended on pre-existing slack. Slack rarely appears in performance metrics. When institutions remove slack for efficiency, they remove unseen stabilizers. The initial decision succeeded because market conditions favored acceleration, investors prioritized short-term growth, structural buffers still existed, reputation capital remained intact. It later constrained because incentives narrowed behavioral diversity, optionality lost measurable value, slack eroded without replacement, risk concentrated invisibly, transfer failed because context mattered. The model traveled. The buffers did not. The vote was unanimous. The constraints accumulated. Incentives do not command obedience. They attract attention. Attention compounds. Compounded attention reshapes institutions. The CEO's decision aligned behavior with measurable performance. It did not anticipate attention compression. Attention compression reduces behavioral variation. Reduced variation increases predictability. Predictability increases valuation. Valuation increases authority. Authority, once reinforced by valuation, becomes harder to question. The system stabilized around its own success. Structural dependency emerged not through failure, but through reward. The institution did not become reckless. It became narrow. Narrow systems are not fragile in stable environments. They are optimized. But optimization reduces range. When range reduces, adaptation costs rise. The CEO's compensation alignment achieved its goal. Earnings accelerated. Perception improved. Authority consolidated. Optionality shrank. The cost was delayed. It was structural. It was non-catastrophic. It appeared as rigidity. Incentives rarely distort immediately. They distort gradually by privileging what can be measured and compressing what cannot. The decision succeeded in its moment. It constrained thereafter. The distortion was not moral. It was mechanical. Efficiency intensified. Flexibility thinned. The system remained strong until conditions demanded breadth. Breadth had been deprioritized. The incentives had not commanded distortion. They had invited it. And institutions rarely refuse invitations that reward them. No lesson extracted. No instruction implied. No empowerment framed. The behavior aligned. The structure narrowed. The vote was unanimous. The dependency remained.